Welcome, everybody. It's Joe Fahmy. It is Saturday, August 24th, a little after 11 a.m. Eastern. Good morning, afternoon, evening to everybody out there, wherever you are in the world. I appreciate you being here. First and foremost, I want to say I'm very grateful for everybody hanging out today. I always start my talks by saying one of the characteristics of successful people is their desire to improve themselves. And by being here, you're instantly telling me that you're looking to learn, you're looking to improve. If you attend any lecture or seminar or anything and you get one thing out of it, then it's worth it. I'm hoping you'll get more than one thing out of it. But you're instantly telling me you're looking to improve, and I have a tremendous amount of respect for you. I'm going to try to give it all I have with going through some great content, answering your questions, and so forth. And I'll stick around basically until the open Monday. I'm okay sticking around till then and answering questions. So we got plenty of time. So really quick, I do have to read a disclaimer that's at the bottom of this first slide here. This information is issued solely for informational and educational purposes, does not constitute an offer to sell or a solicitation of an offer to buy securities. The stocks presented are not to be considered recommendations to buy any stock. The material does not take into account your particular investment objectives, so please consult your financial professional before acting on any information. Basically, I think every disclaimer should just say, don't be an idiot, but that's why I don't write disclaimers, and that's why I'm not a lawyer. Bottom line is, this is only for informational and educational purposes only. So, to give you an idea of the structure, I'm going to go over about 7 or 8 slides and go over the structure of this webinar, and then I'm going to show you how to build a stock screen and go through one of my stock screens and then do a Q&A session afterwards. If you have any questions about anything I'm talking about presently while I'm going through some of these slides, ask them through the Q&A. It's just easier on Zoom for me to follow it through the Q&A versus the chat. If you have any questions about individual stocks, I just appreciate if you save that till later. So, but if I'm talking about something with the fundamentals and technicals and you have a question, feel free to fire away. I'll do my best to answer it. So just a quick introduction for those who don't know me. My name's Joe Fahmy. I have been involved in the markets for over 27 years, through trading, market forecasting, and so forth. I manage money with a firm called Zor Capital. And I also have an educational product on my website at joefahmy.com. Now, where this all came from with the concept of the educational product is I used to do these all day live seminars, and I just realized, why not record them and put them online and turn it into an online product? Because it's difficult for people to travel, and I'm very grateful. I have members, some people said hello from Australia. I have members from all over the world, and I'm grateful for that. So it makes more sense, obviously, with technology to put it all online. So somebody's asking if you can get access to the recorded session. Yes, you will. If you can't stick around, you will get an email with a link to the recording. So what I do in my in these live seminars is I would take people from start to finish. I have a lot of goals in trying to help people improve and build their confidence, and excuse me, a lot of goals with my product, but one of the first ones is to keep people on the right side of the market, which makes sense that it's usually good to expose capital when the market's healthy and to get defensive when it's not. So I go through 4 signs of a healthy market. I'm going to share one of them with you in this in the next slide. And then when the market's healthy, for people who like to trade individual stocks, it'd be nice to expose yourself to growth names, stocks that have patterns or that have the blueprint of growth winners from the past, basically stocks that go up in price from fundamentals. So we go through a lot of the fundamental characteristics. And then when you have that narrowed down, again, for people who like to trade individual stocks, entry point is very important. So understanding the technical patterns. So some people are strictly fundamental. Some people are strictly technical. As I always say, do what works for you. I don't care what people do. My whole thing is the market's hard enough as it is. Put as many factors in your favor as possible to help increase your probabilities of success. So why not combine fundamentals and technicals? That's a novel concept to just try to help you overall. And then when you're in a trade, helping people build their confidence, guidelines on managing the trade, managing risk, position size, and so forth. So I like to think of it from start to finish when the market's healthy, identifying that, being in the right stocks, getting the right entry points, and managing your trades as best as possible. So that's what I do in my educational product. I'm going to get into a bunch of slides. Somebody already asked me what this is. And just really quick, the product is and this isn't a sales pitch. I'm going to get into tons of content. So just bear with me for 1 second. The product is a quarterly membership that's normally $4.95. I have a promo code called Take 100 Off that's good till the end of the month. And you not only get $100 off the quarterly membership, but my web team will add an additional month for free. So you'll have access till the end of the year, till December 31st of 2024, because somebody already asked me what the Take 100 Off is, and that's the discount code if you are interested. So let's jump right in to signs of a healthy market. In my educational product, I discuss 4 of them. I'm going to discuss one of the most important ones for you now because it's very simple. I said earlier, when you attend a lecture, when you attend a seminar, you listen to any sort of talk, podcast, whatever, and you get one thing out of it, it's worth it. If you get one thing out of this and don't remember anything, this is all I want you to remember is the main sign of a healthy market is if we're above or below the 50-day moving average. I use the NASDAQ composite because to me, that's the go-to and leading index. You can use the S&P 500. It's fine. Again, do what works for you. But it's a very simple concept. Plot the simple, just the 50-day moving average is a simple moving average on the NASDAQ, on the S&P, your index of choice. And think of it as a red light, green light. That's what's on this slide here. If we're above it, it's a green light. For the most part, the market's healthy. If we're below it, it's a red light to get defensive. That's one of the most simple concepts because a lot of people tell me, yeah, it makes sense. I'd like to expose capital when the market's healthy, when we have the wind at our backs, when we're in a nice uptrend, when we're in a bull market and all that stuff. But how do I know? This is one simple way to know, by using the 50-day moving average. The second bullet point is it's not an exact science. It's a general red light, green light, a general guideline to be in or not necessarily out of the market, but if for people who like to vary their investment levels to be, a little bit more aggressive or a little bit more defensive, or for some people who like to go to cash to be in or out of the market. Again, it's up to you and your own personal risk tolerance and overall investment plan. So again, it's a very simple concept for people who hopped on late. I use this with individual stocks. When somebody says, hey, can you take a look at XYZ? I'll look at anything. I love looking at stocks. I'll look at it instantly where it is above or below the 50-day moving average. Why this is so important is because this is an area of institutional support. I have friends that are strictly fundamental. They run big hedge funds that are all fundamental based. But when they look at charts, they have one line on it, which is the 50-day moving average, because they even know that that's an area of institutional support, meaning if it's above it, the institutions, your big pension funds, hedge funds, mutual funds are supporting it. If it's below it, it usually, for the most part, means they're not supporting it. And on the weekly chart, it correlates to the 10-week moving average. So I'm sure for people who have heard that expression, the 10-week, it roughly correlates to the 50-day. One is an average on the daily chart. One is on the weekly chart. Now, in my educational product, I go through 4 signs of a healthy market. For the sake of time, I shared one of them with you. It's a very simple concept. Now, one of the goals is to keep people on the right side of the market. I'm trying to humbly say this. I think I've done a phenomenal job of that. For people who followed me on social media or on my blog, I think I do a pretty good job of that. Now, when it's healthy, okay, for those who like to trade individual stocks, now what do you do when it's healthy? Let's move on to the next slide. Why not look at some strong fundamentals? And the title of this slide is Characteristics of the Greatest Winning Stocks. This is throughout history before they made their big moves. Notice something about this slide. Before is in bold. It is capitalized. It is underlined. Not because I'm a drama queen, but to stress the point that William O'Neill, the founder of Investors Business Daily, him and his team, they did studies of the greatest winning stocks throughout history, because wouldn't it be nice to find out what they had in common before Home Depot went on to a huge run, before Microsoft went on to a huge run, before Apple went on to a huge run? What did they have in common? It kind of is common sense that earnings and sales, if you run a small business and you have 100,000 in sales and some decent earnings, and then you grow it to $1 million in sales with some earnings, then you grow it to $5 million in sales with some, don't you think the value of your company would go up? Wouldn't that make sense? It's the same concept that the main reason behind the biggest winners throughout history is the dominant reason is growing your earnings and sales. So, and how much? 30% year over year, quarter over quarter. So we like to compare the fourth quarter of 2023 to the fourth quarter of 2022. So it's not 30% sequentially. And the reason for that is, the summers can be slow for retail holiday shopping season. Wouldn't it make sense to compare the fourth quarter versus the prior year's holiday shopping season? Tech companies have a lot of budgets where their fiscal years at the end of the year, and they tend to have, that's why the fourth quarter tends to be strong. So the whole point is you want to compare apples to apples, meaning year over year, quarter over quarter, the fourth quarter, or let's say the third quarter of this year's earnings that are coming out versus the third quarter of last year's. So that's the main reason behind that. Let's see what else is here. Sorry, give me 1 second. The other reason is increase in sales, 30% year over year increases in earnings and sales. And again, there's 18 characteristics. I'm sharing with you 4 of them. In my educational product, I get into more of them. 80% of them come from certain groups, consumer and retail. Retail can be retail restaurants like a McDonald's, a Chipotle, Panera Bread before it went private. It could be retail restaurants. It could be retail clothing, not just apparel, shoes, and so forth. So that's where consumer retail, computer related, software, semiconductor, PCs, stuff like that. Drug and medical with the big drug discoveries. Financial, leisure and entertainment. Don't underestimate fads, for example, or even booms in certain trends like Lululemon over the past several years. Not necessarily now, just using it as an example. There was a big yoga boom, so that stock did very, very well with a lot of their clothing line and so forth. Going back to the 60s, Brunswick, there was a big bowling and pool boom. Back in the 60s, Brunswick went up like 1,200% in a few years because, again, whatever the fad or the trend or anything that's new that's happening in the times. And then strong technicals, 99% were above their 200-day, 96% were above their 50-day. Going back to that last slide, I look at any stock, but I want to know if it's above or below. And again, these are above their 200-day and above their 50-day. The key word is before they go on to their huge move. So now let me see if there's any questions so far. Let's see. Somebody saying good morning from the beautiful lakes of Maine. Gorgeous today. So no, thank you for being here. Somebody else is in Europe. It's probably a little bit later there, but thank you for being there. Appreciate that. So let me grab some water. I'll be back in 1 second. Okay, I'm back. So for people who hopped on late, what I like to do is try to help people from start to finish. I'm going to simplify it. Identify when the market's healthy as best as you can. When it's healthy, be in some strong fundamental names. Now let's combine some technicals. There's 6, 7, 8 common technical patterns that are formed in my educational product. I go through a lot of these. The main 2 are at the top, cup with handle and double bottom. Those are some of the common patterns that repeat themselves over and over. A lot of people make fun of me for this example because it's from Microsoft of 1990. I know it's a million years ago, but the whole point is I could show you Bethlehem Steel from 1914. Literally I could show you something from last week. These patterns are all the same because, as they say, history doesn't always repeat itself, but it tends to rhyme. Human behavior, fear and greed, where people buy, where people sell, where stocks consolidate, they tend to repeat themselves. So I think it's important to use technicals. So some people don't like technicals, but I don't like some people. So there's nothing wrong with that. Do what works for you. Some people think it's garbage. I think it's because they're lazy and they don't want to put in the time to interpret it. But again, if you don't like technicals, not my problem. Anyways, so cup with handle. Very common question is a cup with handle. Like, what does it look like? We hear cup and handle, cup with handle. We hear that expression over and over. And I've had people say, hey, can you show me what it looks like? And that's not a bad question. I didn't know what it looked like. When I first started trading, I was like, I kept hearing the expression. On the top is what it looks like in theory, where you have a prior uptrend. It gets to point A, you build a base down to point B, the cup is formed, and then the handle is C, D, and E. And then below it is an actual example with Microsoft, and it's on a weekly chart. It can work on daily charts, weekly charts, even intraday charts, where the characteristics are it usually forms over 7 to 65 weeks, usually in that sweet spot of 12 to 26 weeks. The correction from the top to bottom, about 30%, maybe a little bit more in a bear market. You look for improving relative strength, a rounded technical symmetrical U bottom, and then you want to look for some sort of a shakeout in the handle, maybe for the volume to dry up. And that buy point, you might say, well, Microsoft just went from 40 to 80. Why would I buy it there? That's the whole point, is this is what it looks like before they go on their runs. That's what it is. It's not about telling people afterwards. It's trying to identify them before they go on their runs. Let's see. Somebody's saying, can you send out your slides? I'll send a recording of this. So yeah, you will get a recording as well. There's a lot of questions coming in. Some pros warned me about steeply climbing the right side of bases. Why is that a problem? It just, you want to see a symmetrical base. I will say this. The more you put in screen time, I don't mean staring at your screen at charts all day. The more you put in time and look at charts, you will have experience with what feels normal and is normal price action and what is not normal. The best way is, this book is, I don't know, $10, $15, How to Make Money in Stocks, William O'Neill, 4th edition. Go through the first 100 pages of this with the biggest winners throughout history. I don't get anything. I don't care if you buy the book. I'm just trying to share knowledge with you. I think the greatest lesson you can learn on chart reading for literally $10 is to buy that book. A lot of people have that book and it just sits around. Go through those first 100 pages and study them. And they're all marked up beautifully with buy points. What looks normal? What doesn't look normal? To answer that question when it comes up too steeply, or wedges. These are the types of things that not necessarily are advanced techniques, but they can really help you with how to identify these types of patterns. So there's some other questions coming in. Somebody's saying, do you not pounce on drops in stocks that, when they've fallen down? You can do whatever you want. There's some value people that might find value in something, but I like to buy at a proper buy point. In hindsight, it's clear to say when a stock drops and then activist comes up and it pops, or, if stock has taken a hit. There's a lot of different strategies. I'm more of a growth manager where I like to buy good technicals, but I know some people are saying a quality company's down from 100 to 50. I'm not supposed to buy it there. You can do whatever you want. I'm not saying, one of the things I say is I never impose my strategy or ever tell people what to do. This whole world would be so much easier if no one imposed their beliefs on people, politics, religion, and trading ideas. My point is, I'm just trying to share with you some knowledge. You can do whatever you want. If you say XYZ stock is a quality company and it's been cut in half and you want to buy it, go right ahead. You can do whatever you want. Just understand, because of overhead resistance, it might take time to come back, where I'm trying to buy it where there's a least amount of resistance based on history, where it has an opportunity to get moving. So hopefully that helps. Let's see, what else do we have here? So for people who hopped on late, let me go to the next slide. Again, getting people on the right side of the market, identifying when it's healthy, strong fundamental names, getting the right buy point. I say this over and over and over. No matter what your time frame is, get a strong entry point. I have friends who day trade. You got to get those strong entry points. Some people who hold stuff for a couple days, couple weeks, couple years, it doesn't matter. No matter what your time frame is. Wouldn't it be nice if you bought a stock at 50 and, I try to be patient, but within a few days, few weeks, it's at 53, 54, 55. Wouldn't it be nice if you bought it at a level and then you're at a profit within a reasonable amount of time? So now you can breathe easier. You're approaching a trade from a position of confidence. You're at a profit and that feels better. Doesn't it suck when you buy a stock at 50 and 2 weeks later it's at 35 and you're buried in it? And I mean, that's not to say that never happens, but I want to increase the probabilities of success by buying at the right time, no matter what your time frame is. So just to review, Because somebody asked what's in the educational product. I do a 4 or 5 hour seminar, all broken down into fundamentals, technicals, sentiment, market tops, market bottoms, and so forth. In this seminar that I used to run live, I recorded it. It's there. You have the whole quarter, kind of like Netflix. You can watch it on demand. I don't have a catalog that's as big as Netflix. It's just the seminar. I do a weekend video every Saturday that I post by 6 p.m. Eastern, where I go through the current market. I'll show you some examples of what I would do and show some sectors that are acting well. I do a midweek update every Wednesday by 8 p.m. Eastern because I like to take what happened Monday, Tuesday, Wednesday, sort of the cadence or schedule of content, and say, okay, let's look at what happened so far this week and let's see if there's any setups or anything to look forward to for the rest of the week. I do some stock spotlight series and focus lists with some of the higher conviction names, and then I do regular live screening webinars. So if anyone's interested, the promo code until the end of the month is take 100 off. I'm not running any more specials until the end of the year. That's not a sales pitch. It's just I'm just not. I'm just being honest. It's I don't know what else to say. And again, based on the first slide here is the promo code of take 100 off. So if you sign up by August, you get September, October, November. It's a quarterly subscription, normally $4.95. It would be $3.95 to take you through November. My web team will add a complimentary month. So it'll give you plenty of access until plenty of time to assess the product until the end of the year, till December 31st of this year. So you not only get the 100 off, you get an additional month as well. Really quick, just again for some more education. People always ask me, okay, recommended reading list. I'm going to say first and foremost, there's tons of amazing books out there. This isn't the only things to read. There's some that have helped me. How to Make Money in Stocks, William O'Neill. Go through the first 100 pages. The greatest lesson you'll learn in technicals. Put in some work. Go through it. Ingrain the patterns into your mind with the buy points, the sell points, where to stop yourself out, where to take profits, what's faulty, what's normal price action. The more time you put in, isn't it amazing when you work at the gym, you have a better body. When you work at your business, hopefully your business does well. You work at a relationship, it's a little bit healthier. Put in some work, because some people just think the market's so easy. I just open an E-Trade or a Robinhood account. I fund the money in and I trade and everything's so easy. The barrier to entry to the stock market's easy doesn't mean you're going to be good. The barrier to entry to golf, I can go out today, rent some golf clubs and go play golf. It doesn't mean I'm going to be Tiger Woods. You have to put in the time. Hopefully you understand that lesson. I love Jesse Livermore's books. Mark Douglas's books are amazing on market psychology, which I think is 80% of trading. Those are masterful. Victor Sparandeo has some great books on market timing. Nicholas Darvis has a great book, How I Made $2 Million in the Stock Market. It's a funny title, but it's a great book. By the way, if you ever want to write a book on the stock market, title it How I Made $3 Million in the Stock Market, because that probably would sell a little bit better. If I'm at the bookstore and I see how you made $2 million or how you made $3 million, I don't care how the person made $2 million. I want to know how to make $3 million. So in case you're looking to title a book, it's kind of like Something About Mary with the 7-minute abs and the 8-minute abs. I don't have time to do 8-minute abs. I want to do the 7-minute abs. Anyways, Battle for Investment Survival is an amazing book. William O'Neill refers to this one by Gerald Loeb. He refers to this one as one of his favorite books. So that's one. It's amazing. The Livermore, the Jesse Livermore, Gerald Loeb, some of these books. I even think I said this on IBD Live yesterday. It's amazing how these concepts were written 50 to 100 years ago. And when you read it, you're like, oh, I just did that yesterday, or I just did that last week. The same patterns repeat in the markets. So don't think because it was written a long time ago, it doesn't apply to the current market. And this tells you how old the slide is. 3 Market Wizards books. There's way more than 3. Jack Swagger has great interviews with great traders. I believe in the expression, success leaves clues. So study someone who's successful. If you like technicals, study the William O'Neill, David Ryan, stuff like that. You like fundamentals, study Peter Lynch, One Up on Wall Street, another great book I don't have here. My friend Brian Shannon has a great book, actually 2 great books that you can check out for technicals as well. If you like commodities, different styles, there's a lot of people with all these different strategies. And then I said 80% of trading is getting your mind straight. The first video I do in my seminar videos is make sure ways to get your mind straight, because if your mind's messed up, you're not going to make great decisions in anything in life, not just trading. And I think the greatest book on trading that you could buy is not about trading, is Think and Grow Rich by Napoleon Hill. I think that's the best book. When someone's like, what's the best book on trading? That's the first thing I say. But they're like, what does that have to do with trading? It helps you get your mind straight. So that'll help increase your probabilities of success. Norman Vincent Peale, Tony Robbins, just so much great stuff that's there as well. Somebody asked the discount code. It's take 100 off now. And that'll give you $100 off and an extra month my web team will add. Now let's go into the some screens here, because I promised I would show you on this slide here. We went through one of the signs of a healthy market, some of the fundamental characteristics. Sorry if I'm talking too fast. Technical patterns. I discussed the educational product. Now I want to show you how to build a stock screen. So let me go over, bear with me. This is live. Let me go over to Market Surge and share this. And boom, there's Market Surge. And let me just pull up the stock screener. And let me go through a few of the questions. What are things to look for when a stock index is bottoming or reversing after a downtrend? You want to look for, I'm going to try to simplify this. You want to look for volume to dry up. You want to look for signs of stock setting up, the institutions coming back in, signs of accumulation. That's one of the 4 signs of a healthy market that I discussed there. It's not an easy, clear-cut answer, but you basically, since the big institutions control the market, we need to do our best to analyze what they're doing. So when they're buying or selling millions of shares, that shows up on the tape, and you can use a lot of volume to help identify that. How long do I typically hold stocks in my service? I don't give any specific. It's a great question. If I say, hey, I like this stock at 50, I don't tell people how long to hold it. I can identify when the market's healthy and guide you towards a strong stock and tell you how to enter it at 50, but I give guidelines, but I don't give specific targets and lengths to hold it, because I respect everybody has different time frames. You can't tell a day trader to buy it at 50 and go and shoot for a 70 target, and you can't tell someone who's longer term to buy it at 50 and stop themselves out at 49. So hopefully you understand that this is part of the product, is to teach them how to fish, to encourage you to make decisions, to help you build your strength by, I can present the names and give you guidelines, but it's up to you, because please understand, it's a phrase I use all the time. Not everybody trades like you. Not everyone has the same setup. Not everyone can watch the market closely. Some people are working full time. Some people can't watch it at all. I have members in the Middle East, in Europe, in Australia that sometimes they're asleep when the US markets are open. So you have to adapt your time frame and your style to what works for you. So I personally can hold stocks a few weeks to a few months. But again, it doesn't mean anyone else has to. As I said, I don't impose anything on anyone. I encourage you to make the decisions, because that'll help eventually build your confidence. Any volume indication during the handle phase? Yeah, you want to wait when a cup with handle. You want to wait for the volume to dry up as a sign of sellers are actually. I'll go back to that slide, because that's a great question. You want to look for signs of the selling to slow down. So let me go back to that slide. What creates a handle here is people who bought at point A, because a lot of people are just reactive. A lot of people are like lab rats, and a stock goes up and they chase it. I've been there before. Don't take that personally. Just get better at it. So if a stock runs up to point A and it runs from 40 to 80 and people finally jump in and buy it at point A, that's what I mean by getting a strong entry point. And then the market goes into a correction, because cup with handles are usually built when the market goes into a correction. You get to point B. You ever buy a stock at 80 and it's down at 60 or 55, and you say that prayer, please let me get back to even, and I swear I'm going to get out of this? No, we've never been there. No one's ever done that. I'm being sarcastic. You buy the stock improperly at the wrong spot at 80. It drops to 55. And you say, please let me get back to even. I hate this stock. I'm getting out of it. It gets back to even. That's what creates the handle, is all the people who bought at point A are like, get me the heck out at point C. So you want to wait for the volume to dry up, a sign of the sellers drying up. Then when the sellers are all done, all the idiots who bought it at the wrong point, I'm being mean, but you know what I mean. People who chased it and were reactive, who bought at the wrong point, who got out, wait for the selling to dry up. And those are some of the things you can look for during the handle phase. So that's a great question. Let me go back to Market Surge, because I want to show you how to build a screen. How do you recognize when this is happening? I usually see after it's broken out and gone up. How do you recognize these patterns? Is I screen the market. I screen and I look at between 500 to 1,000 stocks every night, going back to put in the work. Some people tell me that they don't want to put in the work and they don't have the time to put in the work. That's what they hire me to do, but you have to put in the work. I screen to get a feel for the market, looking for these cup with handles so I can be ahead of it before it happens, because I love the phrase winners anticipate, losers react. I'm trying to anticipate moves so that when I tweeted out on July 9th, literally right here, that I was reducing exposure after this big run, literally one day from the top. I'm not trying to brag. It's publicly on my blog. I outlined my reasons for it. I'm trying to anticipate that, hey, we've had a good trend for a while. We're due for a pullback. And I'm trying to anticipate things, just like when you see a base being built, you want to try to anticipate these types of moves. And you do that through screening. I'll get into that in a second. Somebody said, appreciate your thoughts. Thank you. What else here? I know you use option flows to get clues. A couple questions about option flows to get clues about possible movements. I'll get into that in a second. That's a longer conversation. What size account thinks justifies your education subscription? You may choose not to answer. To me, education's always priceless. I mean, look, I have people who manage money for big fund managers, and they're big RIAs, registered investment advisors. So I have professionals that, I mean, they probably pay, 10, 20, 30,000 for research. So this is actually inexpensive. I have some other members that trade smaller accounts. I don't know what smaller means because I don't want to insult anyone, whatever, but I do agree with you. Education's priceless. But I'll leave that up to you. No one's got a gun to your head. I'm happy to share and answer whatever questions, but I can confidently say from the emails I unsolicitedly get, usually you email someone when you email an airline when your flight is late and your bags aren't there. I'm very grateful. I'm not even bullshitting. Like, I get great emails that I don't even ask for. No one ever emails things when things are going well. You never email the airline and say, hey, thanks for my flight being early and my bags arriving on time. So I get great emails from people, and I'm confident you're going to learn a great deal. I've been doing this for a long time, and I do regular live webinars like this. I'm confident you're going to learn a great deal, but I can't answer that. If I can't answer, to justify the education, it's totally up. I leave that up to you, and based on your, I don't know everyone's situation as well, but I have some, smaller retail traders, regular retail traders, traders who are trading 7 and 8 figure accounts on their own, and then institutional people that just kind of want my research for their own, funds and so forth. So somebody's saying great book list. What do the different colored lines represent? They're moving averages. That's a great question. Let me get into his screens and then I'll get into some other questions. Somebody said great response on the handle explanation. Thank you for that. I appreciate it. Hopefully that makes sense. What were the clues that made you call that top? It's on my blog at joefahmy.com. It's publicly there. Some of the things I discussed there. For the sake of time, I want to get into the screen. So I outlined all my reasoning right there if you want to check it out. Always enjoy your pragmatic approach to the markets. Your recent appearance on the Compound and Friends was one for the books. That's a lot of fun. Those guys are great. Those guys are great friends of mine, and it's a lot of fun when you work with, or not that I work with them, but you do stuff with friends and people I've known for a long time. They're good friends of mine and super smart, and we always have a lot of fun together. So thank you for that. So let me get into a stock screen really quick, and I'll get to the rest of your questions. Let me grab some water really quick, and I'll explain the stock screen. So I'm back. I just mute while I'm drinking so you don't have to listen to me drink. Okay. I go through my process and I look at the NASDAQ, I look at the S&P, I look at the Russell, I look at the MDY, the mid-cap 400, small-cap 600, NYSE composite. I look at it all. The main two are the NASDAQ and S&P. And I just want to look. Remember I said, are we above or below the 50-day? The red line's the 50-day. So the person who asked, what are the lines? The green line is the 21 EMA. That's the only one that's the exponential moving average. The red line is a 50-day simple, and the black line is a 200-day moving average. Why? Because when you're in these strong trends, my general philosophy is the market's healthy 2 to 3 times a year. Learn to identify when it's healthy and expose capital as best as you can during those times. That's for people who like to actively manage a portfolio. That doesn't work for everybody. But when it is healthy, I noticed that stocks and strong ETFs and indexes hold that 21 EMA. I learned that from Mike Webster, who's a mentor and a brilliant market mind and a great friend. But that's one of the things, because I trust the people who have the resources and have done the studies. I used to use the 20-day simple. He said, change it to the 21 EMA. And when I asked him why, he said, because the studies show stocks during these strong trends tend to hug that line a little bit better based on the studies. I'm going to trust somebody with more market knowledge, more resources, and who's done the studies and listen to smart people. So the green line's at 21 EMA. And then are we above or below the 50-day? That's going to help. And then the 200-day is the longer term area. Paul Tudor Jones talks a lot about that, with the 200-day being very important. So I look at where we are on the index. I have a bunch of screens here. This is something I'm going to say really quick. Everyone's probably like, oh my, what's the wizard behind the curtains? What's in every single one of your screens? What's in the screens doesn't matter. It's being resourceful and putting them together. There's no magical formula. It's just putting in some numbers and going through. The magic isn't in putting in the screens, because even Mike Webster, who I just alluded to, he's building screens all the time. It's not in building the screens. It's in doing the work and going through the stocks and using your brain to interpret what you're seeing. I'll give you a really quick example, because this is actually important, and I swear I'll get into the screen in a minute. Let me go to the pandemic. Okay, this is when the coronavirus news hit. Sorry, just for perspective, February, March of 2020, when the NASDAQ, S&P, Russell, they all dropped 20 to 40% in like 3 weeks, depending on the index. Okay. I wrote 2 articles. I contribute for Yahoo Finance. I wrote 2 articles in the end of March and early April, literally saying that, yes, the coronavirus numbers, the deaths, all those numbers are going to get worse. It doesn't mean the stock market has to get worse. I got ridiculed like you wouldn't believe, which is fine. I'm a big boy. I can take the abuse. That's not the point. The point is, why did I put my neck on the line? Why did I write those articles? For one reason and one reason only, because I was screening. I put in the work every day, and I was saying, well, this is interesting. The news is horrible. You turn on the news, you all want to jump off a bridge. We're all going to die of the virus in 2 days. But the stock market looks actually very healthy right now, because the Fed took unprecedented measures to provide liquidity to the system to prevent the economy and the stock market from a once-in-a-century pandemic from ruining everything. Whether you like it or not, it's not the point. Who cares the reason? That's the facts of the facts. I'm not going to change the world, but that's what I saw. But I'm screening. We had a follow-through day on the S&P 500 on April 2nd, and we had a big one here on the NASDAQ on April 6th. I literally don't remember what I had for dinner last night, but I remember the most random dates in the stock market. But while I was screening, I was going through and I saw something like Zoom that was moving out. Keep in mind, this is March, April of 2020. Zoom was moving out of a cup with handle out of an IPO base. In here in March, April of 2020, Zoom was heading higher. There were some other signs like DocuSign, just to keep in perspective. This is April of 2020, working out of a cup with handle. Now, you might say, yeah, great, Joe. Zoom and DocuSign benefited from work from home. That's great. But it wasn't just that. It was DXCM, one of the leaders in glucose monitoring, probably because everybody was at home drinking and loading up on sugar, so everyone was going to get diabetes. I'm kidding, but not really. That was medical products moving to a new high. Seattle Genetics, which got bought out by Pfizer, I believe, that's not on here because it got bought out. The chart has gone away during mergers. That was making a new high. So you have not only, Coupa Software, DocuSign, not only pandemic stuff, Zoom, but you have medical products, biotechs. A lot of things were moving to new highs. Now check this out. Look what else was moving to new highs. Amazon was moving out of a 1.5, 2-year cup with handle. Look when it was moving out of there. March, April of 2020. Netflix was moving out of this big cup with handle, this big base, if you want to call it that. Look where it was moving out. March, April of 2020. The beloved Nvidia, which, widely owned and everyone talks about 9,000 times a day. This was moving out in April of 2020. So it wasn't just software. It just wasn't pandemic names. It just wasn't medical products. It wasn't just biotech. It was mega caps, Amazon, Netflix, Nvidia. They were all moving out of ranges. And how did I make that call on the market in and wrote those articles right around here is because I was screening and I was saying, you know what, the news is miserable, but the market's looking really amazing right now. And sure enough, 2020 was an amazing year in the markets. I'm not putting aside the horrific part if people had family members that were affected by this. That's not the point I'm trying to make. I'm not trying to be callous about that. I'm just saying from a stock market point of view, you're better off literally shutting off the news, because the news is there to promote fear because of ratings and to make people scared and miserable because they want you to tune in for ratings. If you turn that off and paid attention to the technicals, you'd be much better off. My analogy is you don't turn on the Weather Channel when it's 80 degrees and sunny outside. You turn it on when a hurricane, tornado, or blizzard's coming. Again, that's the same analogy with the news. They always are trying to promote. They never go on the news and you never hear, oh, there's just sunshine and puppy dogs and rainbows. It's all misery and death and horrible stuff. When it comes to the market, you're better off, if you're not mentally tough to not let that affect you, you're better off shutting that off and paying attention to the technicals. I've digressed enough. So let's show you a screen. Let's see a screen here. 30 for 30 is a screen here. Somebody's saying, do you require market surge with your service? You don't at all. I've just been using Market Smith since it was daily graphs. I've been using it for over 20 years. You don't need it for the service. You can do a lot of screens through FinViz. I love the product. I'm not necessarily promoting it, but I don't want anyone to incur a cost that they don't need to. So in my product, I share all my screens for the educational members, but I tried to recreate them using FinViz, FINVIZ, which is a free screener to help you look at charts. So you don't need a you don't need market surge. So where does this 30 for 30 screen come from? So Market Smith has a proprietary rating of 1 to 99. It's a proprietary relative strength rating. So I just go with equal to or greater than 90. So you can see at the top right here, there's 10,279 stocks, over 10,000 stocks. Let's just take the ones that are over 90, because just like Harvard and Yale, they're not going to pick people in the SATs that are like 20 percentile. They're picking the 99 percentile. Unless you're a really good athlete, that changes the story. You can not even take your SATs, really. But anyways, my poor ACTs or whatever. Just like a college is going to take people that have higher standardized test scores, why not choose from the market from the best possible? And you can do that through some of the strong relative strength names. Sales year over year, over 30%, earnings over 30%, stock price over 20. There's no magical number. You can put in 5, you can put in 40, you can put in 100. I don't care. My point is there's no magical number. It's just being resourceful. So to create this screen is really simple. The art is going through it and putting in the time and interpreting it. And again, for people who hopped on late, let me show you where this comes from. Let me just share this so it all makes sense. In the educational slide, bear with me, this is live. When you look at fundamentally, the reason for stocks before they made their big moves is 30% year over year, quarter over quarter, quarterly, year over year, 30% earnings and sales growth. So that's what I chose based on these studies. That's when I chose. Let me go back to Market Surge. Again, bear with me. This is live. Thank you for your patience. Share this. And that's where the screen comes from. Just added relative strength, added earnings and sales 30% or more, picked $20, and it narrowed from over 10,000 stocks to 55. At least if you're choosing from some of these names. This is not a recommendation to buy any of these names. I'm not saying to buy anything. I'm just giving you for educational purposes. At least if you've narrowed it down, it's kind of like for people who follow sports, when they ask a NBA coach or an NFL coach, who are you going to pick in the draft? They're going to say the best player available. It's the same thing in the stock market. Why not pick from some of the best available? That's for people who like to buy growth stocks. Some people buy value. Nothing wrong with that. Do what works for you. So even one of my other screens here, relative strength 99. People are like, what's in your screens? I just pick Relative strength above 97, $20, and trades over 200,000 shares a day to give me 88 stocks. That's what I mean by there's no magic. Like literally a monkey could put this together, feed him a couple bananas. You can hire you can hire an animal to do it. It's not, my point is like, this is not complicated stuff. It's a lot of people think, again, I can't repeat this enough because I get so many emails. What is the secret sauce behind your screens? They're super simple. Putting in the work is where the magic really happens, if that's the right word. So, shut up and get to these. Let me give you 2 bananas and get to your screens. Okay. So now I get to the screens and I'm going through just getting a feel for the market, just going through, like I'll just talk out loud. I see something like this and it's sort of in a downtrend, maybe has support at the 200-day. I would want it to continue to build its base if I'm interested in it. I see something like ALNY, pharmaceutical name, had some good news here, holding its 21-day, looks pretty good. Not necessarily to buy, but just go through, something that might be in a downtrend. I want to see it get back above the 50-day. AppLovin, this is one in software. Look at why this thing has gone from 21 to 90. Look at this, 21%, 36%, 48%, 40%. Earnings, sales growth, earnings, triple digits. Going from losing money to earning over $3, $4 in the next couple of years. Not saying to buy it. I'm trying to explain to you during a healthy market, which has been pretty healthy since, call it May of 2023, a year and a half, over the past 18 months, in a healthy market, for the most part, if a company is growing its earnings and sales, for the most part, it's probably going up. Just trying to educate and explain these things. ARM Holdings, I'm also paying attention to the sectors. So we've already gone through 5 names and I've seen 2 semiconductors. So screening can help you gravitate towards the leading growth sectors as well. I'll go through some of these and looking through, CMT is one I owned earlier this year. It's another one, went from negative growth, slightly positive, accelerating positive. That's why it went from 30 to 140 as their earnings went from 62 cents to over $3. That's, again, if you had a small business and your sales are going up and your profit margins are going up, I'm going to just assume you understand common sense. The value of your company is probably going up. That's the whole concept behind looking at earnings and sales growth. There's some biotechs here. Kava's another one that is growing. They just had earnings. You can see, again, the acceleration. The analysts really like triple-digit growth here. It IPO'd at 22 and opened at 40. Built a really nice base at 58. Built a really nice IPO base. And then broke out of 58.10. Ran up to 70. And look where it came down to, 58.22. For people who tell me technicals don't work, that's because you're just lazy and you just choose not to ignore it, even if it's a self-fulfilling prophecy, whatever. But it found support at the old base breakout. Ran up to 100 and came back down. Look where it retested the old breakout there, the old high, 71.60, 72 right there. So technicals do work if you, do whatever works for you. I'm not imposing technicals. I'm just saying it kind of bothers me when people say technicals are garbage because I think they just don't know how to interpret them. That's just my honest opinion. So I'm going through this and I'm just looking for sort of cup with handles, looking for, type of consolidations. Again, not looking to buy these or saying to buy these. I'm just showing you what I'm looking for. When Eli Lilly broke out and built a handle there and then ran up there, built a second stage base. Full disclosure, this is one I own. I've discussed this. It's one on our focus list for educational members. It's been a leader in big pharma. Going through this, just kind of getting a feel for the market, getting a feel for stocks, paying attention to sectors, paying attention to bases, looking for stocks after they run up and consolidated, to things like that. Just going through and getting a feel. I've noticed a lot of biotechs on here, some financial ones. And what do they all have in common is this 30% or greater in the last quarter growth. So you got some building materials, Mercado Libre. Someone asked me if I look at weekly charts. I do look at weekly charts. You can see this might be, this is the, Amazon of South America. This might be moving out of a big weekly base. So I do look at weekly charts as well. And if you notice, there's some financials, there's some semiconductors, some software, some, medical products, some biotech. This is another one, NTRA and genetic testing. Moved out of this space here, built a cup with handle, moved out of the 63 range, ran up, built another flat base. I describe a lot of these in my educational product. And why has it gone up? Look at this, 27, 43, 52, 58. So in their last quarter, which was just reported, that ended in June of 2024, they did 413 million in revenues versus 260 in June quarter of 2023. So the past 4 quarters has seen accelerating revenue growth. Look at the top line here, 24, 53, 54, accelerating earnings growth as they're going cash flow positive. Someone might say I'd never touch this because they don't have earnings. Amazon didn't have earnings since 2003 for the longest time, and everyone hated it and shorted it. Overvalued. No one decided to put in the work and realize they were cash flow positive and channeling that money into their business instead of just looking at the raw numbers, putting in the work, seeing if a company, what their profit margins are like, seeing if they're cash flow positive, seeing the vision they're trying to build. Then when Amazon started to show profits, the entire world owns it now. They didn't own it then when they were cash flow positive. I get passionate about this stuff because people are stubborn. I'm not saying anyone listening. The people listening are brilliant. You guys are awesome. I'm talking about all those other losers. I'm kidding. I'm just trying to have fun with this. So, Nvidia is another one. Everyone's like, overvalued. Full disclosure, I said this is one of my largest positions. It's been that way for a long time. Why has it gone up? Earnings and sales growth. Everyone's like, it's overvalued. It's a bubble. It's a bubble because you don't own it. That's why you're saying it's overvalued. No one who owns it, same thing with Bitcoin. People are like, oh, Bitcoin's in a bubble. Not the people who bought it at $100. So my point is, a bubble is an asset class that goes up that you don't own. That's what people complain about. Why has Nvidia gone up? They've literally gone split adjusted from 12 cents to over, $3-4 in earnings. Huge growth. And from, 10, 20 billion in revenues to a run rate of over 100 billion in revenues. When a company is growing, some more explosive than others, and the market's cooperating, for the most part, a stock will go up. I've got through half of these. Let me get through some questions here. Let's see here. Somebody's saying, go, Joe. Will you share the FinViz variations of your screens? I do it for educational members. You just have to be resourceful. My friend Jack, Alpha Trends 365, he has some great on his YouTube channel, some great FinViz screens. So I would check that out. But for the sake of time, I'm not being secretive or anything. You can just take some of these and just build them on. Just be resourceful, put in some time and build it. Yeah, but Joe, help me. I help my educational members. I'm doing a lot of help here. There's a lot of free resources, and you can check out his YouTube page. He has a lot of great screens there. How do you check for cash flow on a chart? You don't on a chart. You have to put in some work and maybe dig into some of the financials or read some analyst reports and so forth. So I put in work. If people haven't figured this out, I'm very passionate about this. This isn't about turning on my computer and making money and being a junkie and being addicted to the markets like a lot of people, where I don't really think a lot of people just love the action of the market. I'm looking to put together consistent returns and do my best at it. Am I amazing at it? No, absolutely not. Do I make mistakes? All the time. I'm just trying to improve on my consistency. And I think, like anything else, it's putting in the work. It's putting in the work, being mentally tough. Yes, you need a little bit of luck, but putting in the work is where it's really important. So I don't even know where I was going with this, but a lot of this stuff, unusual options activity, is part of my arsenal. A lot of this stuff is just putting in the work and just doing my own analysis. I look at 500 to 1,000 stocks, mainly because I have no life, but also because I'm passionate about this. And have you ever discovered you put in a little bit of work, you see some improvement in results, a little bit of luck, a little bit of grace, whatever you want to call it. Sometimes things work out. So, and I'm very passionate about this. Powell's another one they talked about on IBD Live. That's another one with growing earnings and sales. They've gone from under $1 to over $12 and building a nice base here. I'm not saying to buy it. I'm just showing you, that's what causes some of these to go up. Going through some of these screens, you're noticing, again, some software, some banking names, some medical products, some semiconductors, some biotech, some banking names, and so forth. So, Supermicro is another one. A lot of people talk about this. They went from $2 to $44. Now, that was the big move from 70 to 1,200. Look at the earnings growth and sales growth. Now, sometimes some of it can be priced in. Sometimes they need time to rebuild. But the whole point is when people said this move was ridiculous, I think going from a billion to 20 billion in sales is amazing. I think growing your company in earnings from $2 to over $40 is amazing. So when people say, nah, it's gone up too much, sometimes you have companies that have explosive growth. Some are slow and steady and make great earnings. An AT&T, a Procter and Gamble, slow and steady. They pay a dividend. Some are, are explosive growth. So, just something to pay attention to as well there. So TMDX, full disclosure, one I own for my clients. We discussed this on IBD Live. Triple-digit earnings and sales in the organ transplant medical products sector. That's another one. Why has this stock gone up on the weekly chart after it broke out here from 30 to 175? Bingo, because they're growing their company. Isn't it an amazing concept? You grow your company and the stock appreciates in price. That's what helps. I'm trying to buy stocks that are going up. I'm not trying to, nothing wrong with parking your money in a dividend name if you want to. That's not my style. Someone who was asking me about Cisco recently, I'm like, oh, they're still public? I didn't even know that. That's kind of a joke. But Cisco pays a 3% dividend. If you want a 3% dividend, you can get more than that without taking the risk on a stock. I'm not mocking Cisco. I'm making a concept here of why Cisco is a great company but not a great stock is they're just doing $3 in earnings every year. Are they going out of business? No, but they've just flatlined their earnings. That's why the stock is the same as it was 6 years ago, is the same as it was 100 years ago there. Not 100, but you get my point. Why is it flatlined for the longest time? Because their earnings flatline. Now, if you want to collect a dividend, 3%, you can get that in a CD in a bank with a treasury in tax-free municipals without taking the risk of a stock going up or down. That's what I'm trying to explain the concept. I'm not mocking Cisco. They're great companies. That doesn't mean they're great stocks. And why are they not great stocks? Because their earnings and sales are not growing. They're just basically making great money and flatlining, and there's not really a lot of growth there. So hopefully that makes sense. Not making fun of names. Stop taking things personally. Stop being offended by everything. I'm just trying to educate. That's what it's all about. So there's a bull market somewhere, and I'm going to help you try to find it. I'm kidding. Anyways, someone said that once. Wingstop was another one. Follow-through day on November. So when you have that follow-through day on November 1st, which was right here, coming off of, we had 3 legs down last year, and from July to end of October of 2023. Right around there, I was on IBD Live, and not IBD Live, I did the podcast, and I mentioned a bunch of names like Uber, Nvidia, and one of the ones I bought was Wingstop. Moving out of that base, it went from 180 to over 400. I didn't hold it for this whole time. I just did well and, had a really good gain in this. And why did it go up? Again, look at this, from under $1 to over $4 in earnings with pretty solid accelerating revenues and great same-store sales, which is not on the chart. It comes from putting in the work. For the person who asked, where do you get same-store sales? Where do you get profit margin expansion? Where do you get cash flow positive? It's from just being inquisitive and putting in the work. Not making fun, I'm just being honest. It's the only way to really answer that question. So that helps you go through one of the screens that I built. Somebody said I just signed up. Thank you for the generous promo. I appreciate that. I'm very grateful for that. Somebody's asking me again about the, I just went to a screen, and I'll be happy to take a bunch of your questions here. Somebody asked me about the promo code. Again, I've been doing this for 27 years. As you can tell, hopefully you can tell, I'm very passionate about this. I have a lot of knowledge in this bald head of mine, and I want to try to share it to help people speed up the process so you don't have to go through all the crap that I've gone through for 27 years, so it can help speed up the learning experience. Because even in the O'Neill book, 300 pages, there's so much content in there. You have to read it several times and go through the charts several times before even 10% of it clicks in your mind. I'm trying to speed up the process. I have a million goals with the product. One of them is to keep people, basically to help you with your confidence so that you can approach the market with confidence, but keep people on the right side of the market, identify when it's healthy. When it's healthy, get into some strong fundamental names. Again, for people who like to trade individual names, I discuss a lot of sector ETFs. If people don't like individual stock risk, ways to get into some of those sector ETFs. So strong fundamental, the strong sectors, which I find from screening. Strong entry points, which I identify from those technical patterns. And then we all just have to, there's an art of mental toughness, making decisions, and doing the best as we can to manage those trades based on our time frame, risk tolerance, whether you can watch the markets or not. Not one cookie cutter solution works for everybody. These are the decisions you have to make on your own. I can't force you into anything, nor do I want to, nor should anyone force you to trade with a certain time frame. Some people have a tax, not consequence, but tax, consequences to think about with long-term or short-term. Some are trading IRAs where the taxes don't matter. The whole point is there's so many factors going into this. I just encourage people to make these decisions on their own. And it's a quarterly membership for 3 months for normally $4.95. There's a promo code till the end of the month. I mean, you can sign up now because you're going to get this week anyways. Basically, till the end of the month, take 100 off is the promo code to give you $100 off. And then my web team will go in and give you the rest of the year another complimentary month, or if you sign up now, technically a complimentary 5 extra weeks to give you access till the end of December. I think that this is going to be a strong fourth quarter. I think the technicals are strong. There's still a lot of growth statistically, and traditionally the fourth quarter tends to be strong. Not always, just probability wise. I think there'll be some great opportunities. That's just my honest feel, but that's not even like, whatever the point is. That's just my honest feel for the markets. I think it's a bull market that started in May of 2023. Bull markets last 3 to 4 years with corrections along the way. We just had one. I think it's going to be strong actually for the next couple of years, but we take it day by day and we reserve the right to change our mind when the facts change in the markets. What you get in the product is you get access to the seminar explaining a lot of these concepts, weekend video, midweek video. I do regular webinars like this where I go through the charts and allow members to ask questions. Again, for the people who asked, the promo code is take 100 off till the end of the month. Somebody asked me if I use Fibonacci. I don't. A lot of people do. It's just not something I do. It's not. I try to keep it simple: price, volume, and moving averages. Let me see here. Let's see. There's a lot of questions. Some people are asking like 50 questions. I'm trying to. And somebody asking 50 questions and saying sorry for asking so many questions. I mean this with respect. There's a lot of people on here, so I'm trying to do my best to answer some of the questions as best as I can. So if I don't get to your question, it's nothing personal. I have to try to do my best to balance this and try to answer as some questions for other people. Somebody asked me about trading around positions. Sometimes I'll keep a core position, let's say of 100 shares, maybe whatever, 5% position. I might want to increase it when I think it could break out and then sell it and sell that added position. Maybe you have 100 shares, you add 50. If it breaks out, you add that position. And then when it breaks out, you just sell that 50 to reduce and go back to your core position. It's called trading around a position. It's not really a complicated strategy, but sometimes I do that around position. Sometimes I might start with a feeler position of 25 shares. I'm just using round numbers for an example. Maybe buy a 1 or 2% position and see how it acts and then add to it then. So it's not always such a cut and dry thing about, with specific positions and how I hold them. Some of the ones I've just held, but I've traded around them, maybe reduced into strength and added on some weakness. Let's see. Let's see here. Some questions coming in. Let me do my best to answer them. Let me go back to market surge. Give me 1 second, and I'll do my best to answer your questions. There we go. Is the S&P in a cup with handle right now? Let's take a look at the S&P 500. I mean, kind of. I mean, it is sort of, if you want to call this like a double bottom. Basically, what happened is we had a liquidity event where the yen carry trade, where a lot of hedge funds borrow at 0% in yen with the rates 0 in Japan. They raised rates. So their computer models say, okay, it'd be great to borrow at 0. Who wouldn't want to borrow money from the bank at 0? So they borrow in yen and other currencies. I'm trying to simplify the trade. But then when you borrow at 0 and it goes up, their computer models say we have to liquidate. I also think there was a lot of complacency in the market. Don't ask me why. It's just the way the market works. It loves to create fear and shake out the weak hands. And I think it was a liquidity-driven event. And I even asked this on IBD Live to the experts there. Sometimes you just have to adapt for what happens in the markets, because even during the pandemic, this was a liquidity event there. And a lot of people, even though we were rebounding, they were waiting for a double bottom there, but we just kept going higher because, this was just a rare liquidity event. It happens in the markets. It's not the market is not going to be easy for everybody. It's not going to just sit there. What's the line? It's not designed to give you money. It's designed to take it away from you. So it's not going to just sit there and let you sit in a low volatility environment and sit back in your rocking chair and make money. It's going to be difficult. It's not easy trading, especially if you want to actively manage your portfolio. So I wouldn't call it a cup with handle, but it would be some sort of a, base structure where it's run up, and let's see if it forms some handle from there. But again, some of these names are subject to interpretation. Joe, great Saturday morning to you. Also great lessons in the PDF, how to find America's Greatest Opportunities by O'Neill. That seems to be ready, available online. Thank you for sharing that. The early cup with handle is evident with big winners. All the charts are annotated comprehensively. A recommendation for learning is to print out the PDF, bind it, and study it. Thank you for sharing that. It's a PDF called, for people who want to jot this down, How to Find and Own America's Greatest Opportunities by William O'Neill. It's a PDF online. And I have seen that one, and I agree. It's not just the markups in this book that help, but there is a lot of PDFs that are marked up. So thank you for sharing that. I really appreciate that. Somebody saying currently their portfolio is moving 2 to 2.5 times the NASDAQ. Is that too much or too little for a growth stock portfolio? I mean, you probably have a lot of high beta names. That happens where beta means a beta of 1. It moves roughly with the S&P. Some people have a beta of 1.5. You can go to Yahoo Finance and see what the beta of a stock is. It just depends on your risk tolerance. It's probably pretty common if you have a concentrated group of names. Like, you even notice ARKK is an example of a concentrated group of 35 to 50 names, where you see something like this on Friday. The S&P is up 1%, 1.15%. The NASDAQ is going to have a higher beta, mean it's going to move on a higher range, 1.5%. ARKK is a concentrated group of high octane, high growth names. I don't like the ETF, but I'm using it as an example. It was up 4.5%. So if you have a concentrated portfolio, yes, it would be normal for you to move more than the markets in both directions. The problem is that it's fine on the upside. No one minds volatility to the upside when the market's going up. But when the market corrects 5 to 10%, a lot of growth stocks can correct 20 to 40%, as you saw with ARM that went from 188 down to 96, or Nvidia that went from 140 down to 90. So many of these names correct bigger than the markets. Even Lilly, which I own, that went from almost 1,000 down to 747. So that's the problem, is, that corrected over 200 points. That's the problem with a concentrated group of portfolio. You have to take the good with the bad. It's going to go up higher than the markets on the up days, but it can drop significantly higher on the downtrend. So you have to manage that on your own. The question is it too much or too little? It's actually pretty common, but there's no right or wrong answer. You're going to have to figure that out on your own, what works for your risk tolerance. And again, people love it on the upside, but on the downside, you're going to have to manage that. Somebody said you asked a great question on Friday during IBD Live. That's why I'm here. Thank you for that. I try, I always want to learn, and they have tons of experience, and some of them I've got to know personally, and they're great friends, and they're just great people. I love that environment there. So I don't mind saying, hey, you guys had access to the studies. You guys might have shared an office with O'Neill, or been around him, or helped him write a book, or helped annotate some charts. I want to pick their brains. I don't have an ego. I love to learn from them. That's why I do ask them questions. So thank you. Does your subscription teach how to create scanners and narrow them down? I include all my screens there, both on Market Search and on FinViz. So I include the screens, and I do regular stock screening webinars to help teach you how to go through and so forth. But I do include the screens. You're just going to have to put in the time. I can show you what exactly like I did. I can take more time during these webinars and show you some of the things I look for. Are trend lines consistently the same colors regardless of what chart you're using? I don't use trend lines. These are moving averages. I don't use trend lines. 21 EMA, 50 simple, 200 simple. So these change based on, after 21 days or 50 days, you take the closing price. That's what creates the average. So It's a great question, but I don't use the trend lines. I use moving averages, which move along with the stock. So when the market is going down, the moving averages are going to move down with it. The shorter term ones are especially. Somebody's asking about some specific stock. I can't answer. If I can't get to all the questions, I apologize. There's a lot of questions coming in. Also, some of them are specific, like, at financial advice. I can't give that. So please understand, and thank you for your understanding there. Is it too late when the stock has had a few quarters of double-digit growth in earnings and sales? No, you find that before a lot of these big winners happen, they have a couple of quarters of good earnings and sales before they go on good runs. It's all covered in the book. So yeah, sometimes the institutions like to see the earnings and sales before they feel comfortable buying it. So it's not too late when you see that. Is a pointed inverse triangle similar to a cup with handle? I don't know what a pointed inverse triangle is. Again, there's funny names to a lot of these, so I don't know what that is, so it's hard for me to answer. Can you tell what the third percentage number is below the earnings and sales? I think it's profit margin is what I have here. Gross margin, that's the number here. Gross margin, which you can just go to the wrench there and click on quarterly data blocks gross margin. So that's what the number is below that. That's gross, not net margins. And, so something like Apple might be a little bit smaller. Yeah, something like that. So that's the gross margin number that's there. Let's see. What else do we got here? Thank you for doing this, Joe. How do you balance weak seasonals with super strong bullish technical alignment? The weak seasonals have me underinvested. Very, very, very awesome and fair question. I use sentiment and seasonality and some of these things secondary to the price action of the market. So the question is, you've had strong accumulation. We had the follow through day on Tuesday, 8/13, followed by a pause day. After you run up and have a follow through day, you don't want to see it give anything back, because we had a day 4 follow through day here on the S&P back on July 31st. And what was it met with? 3 days of accelerating distribution here, or 3 days of 2 out of 3 days of distribution. So after a market or a stock makes a move and you see accumulation, it's nice when it pauses. That's a sign that they're not giving it up right away. Then we had another follow through day on Thursday the 15th, followed by a pause. And then this past week, we had another third follow through day on Monday. We pulled back on pretty light volume. We did have one distribution day on Thursday. One in a cluster after a follow-through day is allowed. People are allowed to take profits after 9,000 straight up days. People were freaking out over one day, and I'm like, how weak are you that the market went up for 14 days, pulls back for one day on a normal pullback to the 50-day, and everyone's freaking out? Learn some patience. You got to learn to be mentally tough. If you weren't freaking out, God bless. That's awesome. Congratulations. If you were freaking out, you got to learn that the market does not go up every single day. Done with that rant. And then we had another follow through day type of day, up over 1.5% on higher volume than the previous day. So the question is, there's great technicals here, but the seasonality's weak. And my direct answer is the technicals override the seasonality. Remember I said the fourth quarter tends to be strong? Yes, I think it's 10 of the last 14 fourth quarters have been strong, but we had a big correction in the fall of 2018 when the Fed was raising rates. Clearly, the fall of 2008 was a disaster. So the fourth quarter tends to be strong seasonally, but if the technicals look like garbage, that doesn't mean you blindly expose money in the fourth quarter. Just like August, September tend to be weaker months, but I've had some great seasonal runs during that time. So I use that as a backdrop, but the technicals of the market and individual growth stocks overrides that. So I like to use it as far as probabilities, but I don't necessarily blindly use it, just like sentiment is a secondary measure to the price action of the markets. And thank you for that. That's a great screen. Somebody said, can you share the 21-day pullback screen? Just because I love you guys, I will. But there's a lot in here. 21-day pullback screen. Again, if you want to jot it down, it's current price above 20, above the, I don't even know what this is. I haven't looked at the screen. I haven't looked at the criteria of this. 50-day average volume trades over 1 million shares. Price around plus or minus 2% around the 21-day. Relative strength above 70. Is the 50-day above the 150, above the 200? Yes. Percent off the highs. Price versus the 50-day. I forget where I came up with this one. I was probably heavily drinking or smoking something. I'm kidding. I don't know where I came up with this, but this is one where you can basically put in, around that 21-day to help you get some of the pullbacks there. So, and that's also in my educational product as well. I like your passion for studying charts. It's just like a radiologist can only be really good if he's excellent at interpreting x-rays, MRIs, etc. You need the diagnostic skills. Thank you, thank you, thank you for saying that. I always say, for people who say, what is a chart going to tell you? The chart tells you the health of a stock or the health of the market, just like the great analogy. Would you go to a doctor and say, no, don't look at the charts, don't look at the x-ray, don't look at the MRI, don't look at any of the EKGs, I don't want to know any of that stuff? You're using that to interpret the health of a patient, so you use charts to interpret the health of the market. So thank you for saying that. It's a great comment. And I'm passionate about it because I don't control the market. You don't control the market. The big institutions control the markets. As I said, the big pension funds, hedge funds, mutual funds, Fidelity, Vanguard, T. Rowe Price. I have a friend who works at Fidelity. He's one of the largest traders there. I don't mean by size. He's in great shape. I mean largest by shares. So when a mutual fund manager tells him to buy, puts an order in with him or to buy or sell, it's 3 to 5 million shares of stock. It's not, it takes them weeks or months to get in or out of it. So these are the types of things that the big institutions, when they're buying this amount of size or selling this amount of size, that consistent accumulation or consistent distribution shows up on the charts. That's why I'm passionate about interpreting it, because I want to ride the market when the wind's at my back and the institutions are supporting it, and I want to get the heck out when they're out of the way. I want to give you another example really quick, because I'm glad someone mentioned that 2020, 22 was a bear market. And let's go to 2022. This was a pretty brutal bear market. Average bear market is 6 to 9 months, 27%. We topped out January of 2022, bottomed out in October. So about 9-10 months, whatever the math is. And we corrected about 30%, 40 on the NASDAQ. So if you just use that 50-day moving average, the red line there is a simple line, and I'm not saying went all cash but got defensive, that would have prevented you from a lot of damage that happened to a lot of people during that bear market. If you just use that and use the black line below the 200-day, the absolute line, longer-term line in the sand, that would have prevented you from a lot of trouble. So when I go to the slides, how there's a reason, a method behind my madness of why I showed you these educational slides. Sign of a healthy market. Are we above or below the 50-day? That way you can help shut out the noise, shut out everyone else's opinion. You wake up in the morning, there's 20 bloggers, there's financial networks, there's 9,000 different social media networks. Someone says we're bullish. Someone says they're bearish. Someone says buy gold. Someone says the market's going to zero. Somebody says hide under the bed in your mom's basement. There's all sorts of noise out there. Shut it all out and just pay attention to the charts. Are we above the 50-day or below the 50-day? And if you use that as a guide, and you go back to MarketSmith here, or Market Surge as it's now called, if you just use that as a guide, I'm not saying you have to go all cash and hide under your bed. I'm just saying during this, you could have just been defensive, meaning reduced your trading, raised some cash, maybe taken some time off. The goal during these times is not to make money. The goal is to protect your money so that when the eventual spring comes, the seasons change for the analogy, or the new bull market comes, then you have your confidence protected, your mental capital protected, your actual capital protected to take advantage of the next bull market. So hopefully that helps. Somebody says, even if the stock names are good, some are strong, some are just strong, some are very strong. How do you rank them to only identify the best? You just do it's a great question. I get that question a lot, meaning after you screen, you go through 500 to 1,000 names because you have no life. You're a geek. We get that. You're passionate about it. And then you narrow it down to 30 names. How do you pick maybe from those the absolute best? You just have to do your absolute best. It's such an awesome question, and there is no right or wrong answer. You just have to make decisions. You have to accept you can't own everything. And I'm going to do it based on the earnings and sales. I use unusual options activity as well to try to help me when I see good bullish flows, maybe some put writing, consistent put writing, meaning it's a big institution that's willing to buy it on the way down, meaning support it. So I use a lot of factors and I just do my absolute best. Somebody's asking me what's happening with Vital Farms. I don't know Vital Farms. Let me take a look at Vital Farms. Food and meat products. It looks like it IPO'd at 22 and it's in a downtrend. Oh, sorry. Maybe I should reset the chart to today. There we go. Sorry. Vital Farms, food and meat products. I don't know this chart. Produces and sells organic eggs, butter, and so forth. What is happening with the chart? Let's see. Can you talk about a stock like this? And I mean, look, it broke out of a base here. I don't know this name. It went from 15 to 48. What is happening is stocks have retracements. I'm not being a wise ass. When a stock just went from, 15 to 48 and went up, 300% or whatever the math is. I mean, it's pulling back here. What would I look to get back into something like this? I'm not in this. I would look to, to see if it builds a base. But again, there's a lot of different strategies. If you've done the fundamental work and you like a company, I like to buy at a proper technical time, but some people are buying things, because someone asked about Starbucks. Are you saying don't buy Starbucks down here, because it's below the 50-day and below the 200-day? Well, yeah, no shit. If I knew an activist was going to come out and they were going to replace the CEO and all that stuff, if I had a crystal ball and had tomorrow's newspaper, of course I'd buy it. I'd put my whole net worth into options that week. My point is that a lot of this stuff is in hindsight. How do you know in a downtrend that you shouldn't have bought Starbucks here or bought it 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 here? Why are you magically picking I shouldn't have bought Starbucks 2 weeks ago? No shit. Before a huge gain, everyone wants to buy it. I'm talking in terms of probabilities. So if you want to buy a company like Vital Farms, if you've done the work, or Starbucks, which is a great company, but again, just like Cisco, they're earning $3 every year, kind of flatlined. If you want to buy these companies and buy value, or you think what you perceived value, understand that when you buy in a downtrend, number one, start small. Number two, realize that you might have to buy a little bit lower. And number three, realize that it might take time to come back if it comes back at all. So understand that if you've done the fundamental work on anything and you like a company, 3 rules. Start small. Don't have the arrogance to say, oh, I'm going to buy it here and it's going to turn around. If you want to buy 100 shares, start with 25. It's just a different strategy. Number 2 is have the humility to understand it might go lower and leave room to buy something even lower. And number 3 is you're going to have to accept it's going to take time to come back. So, and the beautiful thing about this, if I sound passionate, I'm not yelling at anyone or forcing anyone to do anything. I'm just telling you, I talk in terms of probabilities. You can do whatever you want. Just understand there's different strategies, which I completely respect, and understand when you buy value or things that are beaten down or things in a downtrend, do whatever you want. Just manage risk and understand it might take time to come back from that overhead resistance. A lot of questions coming in. With IBD Live, they have an amazing team and 4 or 5 people behind the scenes answering all these questions. So if I can't get to them or if it's taking some time, just realize it's just me right now. So, so thank you for your, how does Buffett sell millions of shares of Apple and nobody knows it? It's because this is a $3.5 trillion market cap company. It trades, 61 million shares average volume. If I had the capital and wanted to buy 5 million shares of Apple or sell 5 million, it's very liquid. Microsoft, Apple, the Qs, the SPY, they're so liquid that how does he get in and out without anybody knowing? It's fairly liquid. So I'm not saying he buys it all in one day. Sometimes he might be selling, if he sold last quarter, he might, I don't know, what's the last quarter from April to July. He sold during this time. He might have sold some here. He might have sold some here. He could have sold some on the breakout. He could have sold it all in the breakout. He could have sold it all in the dead low. I don't know. You'd have to go down and break down the sales, but it's pretty liquid and traded 61 million shares times about 65 trading days in a quarter. That's a lot of shares that he can get in and out of it, no problem. It's just liquid. You can't get into a small cap, a biotech with that size. But what pattern do I find most reliable? Cup with handle, double bottom, flat base. I use them all. Ascending base, high tight flags. I use them all. I was just saying cup with handle and double bottom are the two most common ones, but I use them all. Can you point us in the right direction as to what to look for in the option chain? That's a whole can of worms. That's not something I can answer, and I could take 10 years to answer that. Let's see, what else do we have? What is the meaning of life? That's hilarious. That's a quicker question to answer than options. Do you use multiple time frames to time your entries? Yes, I use 5-minute, sometimes daily charts, intraday charts, weekly charts. If they all correlate, that's good. How do you move up your stops? It depends on different situations. I also sometimes try to sell into strength where I might not keep a trailing stop. I just might want to sell into strength when we had this great run here and I sold right there and reduced considerably. It was just selling into strength. By the way, I did get lucky. You do need to get lucky once in a while, but I also tweeted out back here on July 23rd of 2023 after a similar thing. We broke out May of 2023. When I say the market's healthy 2 to 3 times a year, these times last about 6 to 12 weeks. So we had a really nice power trend. I literally tweeted out the same thing. I mean, yes, maybe I got lucky twice, but it's sort of a gut feel instinct, trader instinct. When a market's run so much and we've run into strength, I tweeted out that I was reducing there on July 23rd, and we ended up having a 3 legs down to the 200-day and a 10-11% correction in the S&P 500 before last November's follow-through days. And there were no trailing stops there. I just decided to take profits because sometimes I don't have a trailing stop. I just say, okay, enough is enough. I've gone on a good run. I'm locking in profits again with that word, with the higher probabilities of a pullback usually coming based on experience, based on instincts. And sometimes I get it right. Sometimes I get it wrong. And I have no problem being wrong. I'm wrong all the time. I just don't stay wrong, as they say. What else do we got here? A lot of questions coming in. Somebody's asking me about the discount code. I appreciate that. While I get to the other questions, it is take 100 off for the educational product. Take 100 off. It's good till the end of the quarter. Excuse me, end of the month. Sorry, misspoke. August 31st. Between now and a week from now, you can sign up. You get 100 off your quarterly subscription. My web team will give you a complimentary month. It's the last special I'm running for the year. That's not a sales pitch. I'm just being honest. That's the truth. And you get an extra month, so you'll get till the end of the quarter. Excuse me, I'm misspeaking. The special is till the end of the week. You'll get to the end of the year. My web team will add the extra 4 weeks. If you sign up now, you're gonna get an extra 5 weeks to give you access till the end of the year. And you get the seminar, regular videos. I've not done my Saturday video. They're about 20 to 30 minutes long, breaking down the markets, market commentary, going through the leading sectors, presenting maybe some entry points, general commentary on certain stocks, things that I'm looking at. I include a write-up because some people don't have all the time to watch these videos. So you get a feel. I've shared some of those write-ups on Twitter. You get a feel for the market and what I'm thinking. Unusual options activity is listed for educational and informational purposes. And a lot of people ask me how I use that. There's a big art to it all. I try to explain some of it, but some key things is I'm looking for consistent flows of buying. I'm looking for consistent put writing for institutions that are willing to buy. I'm looking for something unusual, especially with biotechs, because I'm not an expert in biotechs. I don't know what a p-value is in a phase 2 study, but I have super sharp resources because I try to be nice to people. Isn't that a concept? Try to be nice to people and they're nice back for the most part if they're not assholes. But my point is that I have some great friends that are super, super smart. One of them is a high-end analyst in biotech at one of the firms. that I'm resourceful with, and I might ask their opinion. Some people who are super sharp biotech fund managers. So I kind of try to be resourceful, but because I'm not an expert in biotech, I use unusual options activity to help me with that. And we've done well this year with a few names. CINC, there was a buyout on that one, but earlier this year, CYTK entered this one around 30, and it had that big news and ran to 110. And Viking VKTX, which everyone follows now, and all my videos are archived, so I'm not bullshitting. I mentioned it off the high tight flag and the unusual options activity, all the tightness in the chart. I literally mentioned it like 50 times, not 50, but like 10 times over that month period that I was in it in the low 20s. It was a high tight flag, and the news came out and it ran up nicely. And it was so we've had a couple of really nice gains. Even some that MGNX that was a high tight flag here from 5 to 10. I said, look, this could double in a short period of time. It ran up. I sold some in here. And I think on the breakdown there, I sold some. Yes, it gapped down and fell apart, but I'm sorry, if you get a double on a stock from 10 to 22 and you don't take profits. I was telling educational members, you know, what do they say? Bulls make money, bears make money, pigs get slaughtered. I took it off the table when it broke down. I got out of it. And the news was not good, but the unusual options activity helped us with a double in this name. Yes, it fell apart afterwards, but if you don't take profits on a double, I can't help you there. That's so I've used some of that unusual options activity for some of the biotechs as well. Let's see what else we got here. Somebody said they're registered, they're looking to learn. I appreciate that. That's somebody saying you crack me up. I go on rants sometimes. No one wants to listen to boring. No one wants to listen to somebody saying, okay, let's take a look at the economy and the jobs report. You will snooze without any Ambien. You will just literally knock right out. Nobody wants to listen to boring. I am trying to take a subject that is kind of dry, technicals, the stock market, all this stuff, and I'm trying to keep it engaged. I'm trying to keep you. There's a lot of people on here. We're an hour and a half into this, and I'm grateful that a large percentage of the people are still here. I'm trying to keep you engaged, trying to keep you interested, and I'm blessed with, I think, a personality that does that. And I also get great compliments that I try to break things that are complicated to simple. And if I can make you laugh, that's great. Even if you're laughing at me, that's great too. I'm okay with that. So thank you for that comment. Could you please go over your inputs for the 30/30 stock screen? Yes, it's again, it is relative strength above 90, earnings and sales for the past quarter greater than or equal to 30%. You can put in whatever price you want, 5, 10, 20, put in a million. I don't care what you want to put in. I just picked $20. There's no rhyme or reason for it. I don't like to buy penny stocks or low price stocks, but I could easily put 40 or 100 there. And then average volume. Mike Webster, I think some people use 500,000 shares. I use 200,000 shares. You can use whatever you want there. Again, there's no magic to it. You just have to just be resourceful and play around with it. That's it. Number of stocks an individual should hold at any one time. That's I mean, O'Neill's guideline is, you know, depending on your portfolio size. I think 10 to 20 is a good sweet spot. Some people have FOMO, fear of missing Oprah. That's a joke. Some people have fear of missing out, and they see everyone on social media is talking about X and Y and Z and A and B and C, and they just feel like reactive. I got to jump into everyone because everyone's jumping in. First and foremost, don't have FOMO. FOMO's for the weak. Don't be weak. Second of all, a lot of these people are not trading, so stop thinking just because people are tweeting about things and talking about things that they own them. Third thing is you can't own everything. So that's a great question. How many stocks should you own? But if you own 100 stocks, that's kind of overly diversification. I've had people send me, you know, statements from, you know, other advisors and so forth. I'm not making fun, but they own 200 stocks and 37 mutual funds. And I'm like, oh heavens, you own 9 million shares. You get plenty of diversification just from owning the SPY, 11 different sectors in multinational companies. I mean, that's pretty great diversification. So my point is, if you feel the need to own too much, number one is get over that need, accept you can't own everything. And then when the downturn comes, you're in a portfolio of 90 stocks and you're like, what am I even doing? Why do I even own all this? Scott Sinclair on IBD Live said a great thing that he just can't follow too many. And I'm the same way. So it's really hard. I'd rather keep it concentrated, but that's not for everybody. So the number is, it depends on your own risk tolerance, and it's a great question. Let's see. There's some other ones. Was there fear during the drop of the yen trade liquidation? Yeah, I discussed this. I even wrote about it on my blog and discussed this during IBD Live. That I look at a lot of sentiment measures, and when we had that flush there, yes, a lot of fear was created and flushed a lot of people out, and that's what created the low. Besides bouncing off the 200-day, so the fear coincided with a technical level. And yes, that's what happens. People are very reactive. When things go up, everyone's bullish. When things go down, people turn bearish. So when someone asks what was one of the reasons I reduced here, besides the market being extended and heading into a seasonally weak period, the entire world was loaded up and super bullish. I look at NAIM. I look at investors' intelligence, which is an oxymoron. I look at put to call ratios. I look at AAII. I look at CNN Fear Greed, Ned Davis Research. I look at 7 or 8 different sentiment measures, and all of them were at the higher end of the range. All the kids were in the pool, and a shark was about to come. I mean, that was an analogy, but everybody was loaded up, because when the market goes up and you're sitting in your rocking chair and everything goes up, it's so easy to get bullish. And then the market says, oh, okay, you're bullish. I'm going to stick it up. You know what? And that's what happens. And that creates fear. And people say, why does this happen, or why does it have to happen? It's called the markets. It's not supposed to be easy. It's part of the markets. And it's our job is to do our best to manage things and manage our emotions around this. A lot of great questions coming in. Somebody said they have to leave. Thanks a lot. I liked and continue to learn a lot from this. It's difficult to carry these out on a day-by-day basis. Yeah, I'm not saying trading is easy. The emotional control that you need. You never want to make an important decision at a heightened state of emotion, not just in the market. That's a life lesson too. But if you find yourself getting too emotional in the markets and having trouble with all this, reduce your position size. Stop trying to make $10 million by Tuesday. Joe, I want to make $10 million by Monday. I don't have time to make it by Tuesday. Just relax. Go for slow and steady. The eighth wonder of the world is not Andre the Giant. It kind of is, but the eighth wonder of the world is compound interest. If you love this and want to do this for the next 10, 20, 30 years, and you're passionate about this, slow and steady, if you compound your account and can do that with minimal drawdowns, you can't help but being successful. So stop. If you're nervous, it's probably because your position size is too big. It takes one to know one, meaning I've been there before. I'm not being critical. I'm trying to help people learn from my mistakes, that when I've been fearful, I was like, yeah, my position size was too big. Reduce it down, relax a little bit. Let's see. There's a lot of great questions coming in. Do I use options or just commons? I use unusual options activity to help me guide towards stocks, but I don't trade the actual options. I use it for informational purposes. A lot of members do trade options. It's a great question and a fair question. I usually use common stock. So when I see put writing on XYZ, I just buy the stock. I don't write puts against that. Somebody's saying you're doing a great job. Thank you. I appreciate that. It's called diversification. Oh, is that a line about diversification or undoers, meaning you're drinking scotch or I'm kidding. Yeah, it's called overkill. Even Warren Buffett and William O'Neill have used that expression, diversification as a hedge for ignorance. If you have confidence in what you're doing, you can keep it concentrated. If you don't, keep in mind, you can be diversified, but keep in mind, you don't only have to trade individual stocks. As much as we love trading them, you can use a blend. No one's got a gun to your head. The beautiful thing about an individual trader is you can do whatever you want. If you want to own some ETFs and trade a few stocks, you can do that too. You don't have to have when somebody asks that great question, how many stocks should you own? You don't have to have a portfolio of individual stocks. You can say, as I'm learning, let me buy 2 or 3 or 5 stocks, not 20. Let me buy 2 or 3 and get a feel for stocks, but hold some SPY, maybe hold some Qs, some IWMs, whatever ETF you want as well. Mm, Let's see, what else do we got here? Do I think the Gators will have yet another losing season? I'm assuming you mean Florida Gators college football. I've not followed them. I know they won the national championship when um, Urban Meyer was there. I've not followed them. I know they haven't been done as well. There's a lot of competition in sports, especially in the state of Florida. There's so many amazing athletes that it's not just Florida State, Miami, and Florida. There's South Florida and also Central Florida. There's a lot of competition. So same thing in basketball. Sorry for the mini diversion here, but a lot of these schools say, hey, you can go to a great school and sit on the bench, or you can come here and play. And that's what causes a lot of these great athletes go to different schools. So I don't know about, I have not looked at Florida's prospects. Can you please share the recording link? Yes, you will get an email with this link when it's done. I got about 5 or 10 more minutes. It's approaching 2 hours. Great job on the webinar. What do you make of sentiment being even more bullish now than before the yen carry unwind? I see that sentiment has come back, where it was super bullish here and then we dropped and it stayed bullish. In other words, everyone bought that dip and the market said, okay, you're not going to get fearful. Let me create some fear. Now it's come back, and I've not looked at all the sentiment measures, but it's definitely come back because human beings are very reactive. Human beings get bullish when things go up. It's human nature, and get bearish when things go down. I've not looked at all of them to answer if it's more bullish now than before the yen carry trade. I like to look at a conglomerate, but maybe after it's run, healthy wise, maybe you see something like this. I don't know, some sideways digestion with some shakeouts, maybe some profit taking. We'll take it day by day. But I've not looked at all the sentiment measures. That's part of my weekend work that I've not looked at. Andre the Giant versus King Kong Bundy. Who taps out first? Of course, King Kong Bundy's out. Andre the Giant, there's a great documentary on HBO called Andre. Fascinating, fascinating story. The guy used to drink like 24 beers in a car ride. It's just amazing. I love that story about him. Do I look at price versus earnings or sales growth multiples? Sometimes I do, but it's not a factor in my work with price to sales or price to earnings. It's probably one of the most overrated uses. So PE matters in a bear market, but in a bull market, Apple was 72 PE and no one wanted to touch it. Then it goes up 3,000% and becomes the most widely held stock. So you get what you pay for. A lot of times you find the PE is higher, and then after it runs, then the earnings come in. So that's why PE is not helpful. Joe, this has been very helpful. Thank you for taking the time. Let's see here. There's some specific, like, I'm trying to get through these questions. There's some specific, what's the word? Specific investment advice questions I can't answer. Let's see what else. A couple names. Somebody's asking me about some medical product names. Let me go through a few more charts. What do I think of GMed? I don't follow GMed. Looks like it's working on a base. I mean, it looks like on the weekly chart, this is sort of a big base here. I don't follow it, but it's medical products, decent relative strength, pretty good growth. I don't follow it. LNTH, someone on IBD Live talked about this. They had great earnings. They came back down when the market corrected in early August, and it's held its 50-day. So that looks decent. AVTR, just to look at a few of them. Again, medical products. I don't know this one, but looks like it had a big run, and it's been consolidating for a long time here. And again, it's probably consolidated because they've basically been flatlining their earnings. If their earnings picked up, it might, looks like they had a good quarter here. Maybe they gave good guidance. I don't know this one, but looks like the technicals are improving. What else do we got here? Thank you for your generous sharing. I appreciate that. Somebody's asking me again, the discount code. It is take 100 off, and it's good till the end of the quarter. I keep misspeaking, to the end of the month, and it'll give you access with an extra. It's a quarterly membership. Good to the end of the month is the code. It's the last discount I'm offering this year, and it'll give you access until the end of, my web team will add an extra month. So you get access till the end of the year. So Christmas is coming early, Christmas in August, as they say. And I do a lot of content, as I said, with the twice a week videos and the regular webinars as well. Do I think people should stick to investing, swing trading, or day trading? That's a personal thing. It just different things work for different people. What is the special $100 offer discount for? Is it a website like IBD? Is it useful for those who are learning basics of charts? IBD is an extensive Investors Business Daily has been around for a long time, and they have tons and tons of web developers and so forth. It's just behind the scenes. You get I think it's like 10 or 12 videos. That is my seminar videos, and then I do regular weekend videos and midweek videos. So it's not a website. It's by no means as robust as IBD with that type of education, because they obviously have an insane team of people. I have web developers, but it's mostly me creating the content. It's all me creating the content, but no, there's not like, like it's not a Netflix of libraries or something. I mean, it's again, I'm confident you will learn a great deal, even if you're a beginner, for learning the basics of charts and fundamentals. But I'll leave that up to you if you feel comfortable with that as well. Let's see, what else do we have here? Do I believe that certain sectors must participate for the general bull market to continue? Financials, tech, and so forth. It'd be nice. It's a great question. It'd be nice if they all participated, but of the 11 S&P sectors, if all of them can participate, but maybe if interest rates are coming down, utilities will rotate. I don't try to chase that sector rotation, but it'd be nice if small and mid caps participate. The broader, the better. But I've also seen narrower bull markets that are pretty narrow as well. So it's a great question, but a very difficult one to answer. Ideally, you'd like a lot of them to work out. That leads to this next question: with the equal weight S&P and small caps breaking out, seems like this uptrend is broadening out. Do I think that indicates a shift away from concentration on the Mag 7? Recently, yes, but that doesn't mean that I would rule out the Mag 7. As I just said, it's a good thing if a lot of sectors are participating. So, and again, someone said the website, joefahmy.com, you can go to, click on the investor education tab. You can sign up there. Somebody said, thank you for your explanation. Bottom line is, I'm very grateful, as I said from the beginning. There's a lot of people still here, almost 2 hours into this. So thankfully, I didn't bore you. Maybe a lot of people fell asleep, and wake up if you did fall asleep. I'm kidding. But I'm grateful for you guys hanging out. Hopefully you learned something. I will send you a link to the recording. You might want to go back. Some people like to take notes and so forth, look at some of the slides. But as I said, I'm grateful for the opportunity to explain some of this. Hopefully you learned something and got a little bit out of this. As you can tell, I'm very passionate. And if you're interested, no one's forcing anything. If you're interested in learning some more, I try to do my best to take 27 years of doing this, simplify things, and speed up the learning curve for you. If you're interested in more content, you can sign up for the educational product with the discount code. I'm confident you're going to learn a lot. I've got great feedback, and I try to do my best to provide some consistent some consistent content. I said consistent profits. I don't provide that, but keep people on the right side of the market, help to build your confidence so that you can make decisions on your own. And that's really what it's all about. So at the end of the day, I'm getting a lot of thank yous that they learned a lot. So I really appreciate that. Somebody says they're giving me a rating of 99. And yes, you are as robust as IBD, keeping the difference in scale in mind. Thank you for that. I appreciate that. I appreciate the kind comments. And as I said, what it's all about is that mental toughness and building that strength, because 80% of it is psychology. You just have one assignment for the rest of the weekend. Get outside, do something to help your mental, your mental health, your physical health. Read a book, get some sunshine, tell someone you love them, call a friend you haven't called in a while. There's more to life than the markets. I believe in being well-rounded. As you know, I post some stuff. I have some great friends. I'm blessed to, have some great friends in the music industry, go to concerts, this and that. do something that helps your overall life, because there's more to markets than just sitting inside and staring at screens. So your only job for the rest of the weekend is just step outside the house, read a book, smell some fresh air, do something to help your mental and physical well-being. So thank you so much for hanging out. As soon as this is uploaded, I'll do my best later in the day to get you a link to it. Enjoy the rest of your weekend. Thank you for all your awesome questions and great comments. And we'll hopefully do another one next time. Thank you so much.